Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. As expected, yesterday the Reserve Bank Board left interest rates on hold at 4.35%. The big question now is, when will the first cut be? Gareth Aird is Commonwealth Bank's Head of Australian Economics. Gareth, welcome back to Fear and Greed.
G'day, Sean. It's nice to be with you.
What do you make of yesterday's Reserve Bank statement and the press conference and everything? Michelle Bullock was pretty clear. The board doesn't know which way they're going to jump next, or is she hiding something?
No, look, I think they just want to keep full optionality out there at the moment. And in a lot of ways, I think they've been scarred by the forward guidance of 2021, where they thought they wouldn't be raising rates until 2024 at the earliest. And they continued to basically make that case. And obviously that turned out to be anything but, given we've had 425 basis points of rate hikes before we got to 2024. So I think right now the RBA doesn't want to commit to doing anything in the future to the extent they'll be guided by the data. And I thought in the governor's press conference, it was basically a long-winded way of saying we haven't ruled anything in or out. In other words, our next policy decision or our next policy move rather will simply be guided by the data.
Some are suggesting that the wording in the statement yesterday suggested that they've lost their bias towards tightening. Do you agree with that?
Yeah, look, I do. And that's what I put in our notes actually yesterday, that the statement actually moved officially away from a hiking bias to a neutral one. And the change they made there is, from last month, they said a further increase in interest rates cannot be ruled out. Whereas this month, they just said the board is not ruling anything in or out. I mean, in some sense, you could argue it's semantics, but really what I think's happened is over the last month, the run of data has left the board increasingly confident that they won't need to raise rates again. They still haven't, of course, ruled that out, but they're now not making an explicit reference in the statement to a further increase in rates not being ruled out.
How do you think Michelle Bullock went in her second press conference yesterday? It can't be easy for a Reserve Bank governor to stand in front of the media and answer those questions. And many of the questions were exactly the same one, as in, do you have a bias towards one way or another? But she seemed to handle it fairly well. How do you think she went?
Yeah, look, I think she went well to the extent that the board just do not want to provide any forward guidance at the moment. And most of the questions were really around what do we need to see to get some rate cuts, and when are we likely to get some rate cuts? And it makes a lot of sense to some extent. The press is asking that because there are many, many home borrowers out there wondering the same thing. But the central bank does not want to commit to giving a timeline on when they think they might be cutting interest rates. And that's something that we're a little bit different here in Australia compared to other central banks, where, for example, with the US Fed, Fed members provide what's called a dot plot, where they outlay where they think rates will be over a multi-year horizon. We take a different approach here, and the RBA is basically not wanted to commit to where interest rates may land in the future. And I think it just goes back to that point of forward guidance in the past not actually being particularly beneficial for households, and they probably just don't want to get home borrower hopes up at this stage. And I think they're going to wait till just before they're ready to cut rates before sending the message that the next move is down.
Stay with me, Gareth. We'll be back in a minute. I'm speaking to Gareth Aird, Commonwealth Bank's Head of Australian Economics. She said that the war on inflation hasn't been won yet. How do we win the war on inflation?
Well, we basically just continue on the same path that we are, and that is you have below trend economic growth, and GDP growth has been particularly weak, and I think that fed into the shift from a hiking bias to a neutral one yesterday. The national accounts that were out a couple of weeks ago told us that over the course of 2023, the quarterly growth prints were sequentially 0.6%, 0.5%, 0.3%, and 0.2%. So as economic growth has slowed, particularly around household consumption, that is making it harder for businesses to put up prices because consumer demand has softened. And you've also got as well the labour market loosening, which puts downward pressure on wages. So all of that ultimately helps to lower inflation. But the RBA cannot declare the war inflation won until they're actually ready to cut rates, because if the war on inflation had been won, then we shouldn't have policy at a restrictive setting. So, I think we're still another quarter or two away from getting to that point. But if we continue down the path that we're on at the moment, hopefully the RBA is declaring victory in the second half of this year.
Okay, so that suggests, Gareth, that you think interest rates will fall in the second half of this year. If so, how far do they go down? We're not going to go back to what we've seen. Obviously, they were emergency measures post-pandemic or during the pandemic. What is a more normal interest rate?
Yeah, Sean, look, it's interesting the way you put that question, because I think it's easily forgotten that pre-pandemic, the cash rate was just 0.75%. And at the time, nobody thought that we were at an emergency setting. So it only took a couple of rate hikes at the start of the tightening cycle for the cash rate to end up above where it was pre-pandemic. And now we're at 4.35%, which is well above where we were pre-pandemic. We think the neutral rate, which is this kind of concept around what is a steady state interest rate if you had inflation roughly in target and the economy growing about trend pace, we think that interest rate is somewhere around 2.5% to 3%, which means at 4.35%, we're quite above that at the moment. And we're increasingly feeling confident that that is about the right guesstimate for a neutral rate because of how much the economy has slowed under where rates are at the moment. So if you then think about what would the central bank be doing in terms of an easing cycle if it's time to take policy out of a restrictive setting, well, it would be to actually take the cash rate back to a neutral sort of level. So on our profile then for the RBA, we've got them starting an easing cycle in September and delivering 150 basis points of cuts over a 12-month period, which would get the cash rate to 2.85%. I think that the risk to our view here is that the RBA themselves think that the neutral rate is higher and therefore they don't take rates down as quickly. They pause at something like 3.5% or maybe a little bit under and watch the economy for a while before determining if they need to take rates any lower than that.
One thing that Michelle Bullock was asked yesterday was the impact on house prices if rates do start falling. And she basically said it's too hard to predict house prices. However, demand is higher than supply, and a very basic macro one forecast that. But just going on with what you're saying, if we do start seeing cuts in mortgage rates eventually, what does that mean for house prices? Because it's an incredibly resilient market out there.
Look, it is. And we've seen house prices rise. We saw house prices lift through 2023 and the RBA was hiking. And house prices have continued to rise in the early part of this year with the central bank on hold. So if the RBA is going to then take the policy rate lower, which means that mortgage rates will come down, you can only see house prices picking up further. Now, the central bank, if that's to occur, the central bank is still going to put weight on their inflation target and full employment, and they don't actually have in their mandate anything to do with house prices. And it's really up to other arms of policy, particularly on the government side, to pull a couple of levers if they want to stem the speed at which house prices are rising. It's not really one for the central bank. And I think if we think about the issue from a sort of a societal perspective, what's gone on in the housing market has not been good. We've had incredibly strong population growth. We're not building enough homes. Vacancy rates are very, very low across the country and rents are rising very quickly. And all of that in turn is putting upward pressure on home prices. So if the RBA is taking rates lower, home prices could end up rising quite swiftly. But that's simply something the central bank would need to look through, given they'd be more concerned, we think, with rising unemployment.
We've got labour force figures out tomorrow. What's your thoughts on that?
Yeah, look, at the risk of giving a prediction now, giving a lot of listeners might be listening to it after the labour force numbers have printed. Our call is for the unemployment rate to tick down from 4.1% to 4% and for a decent lift in employment. Now, that sort of numbers might sound like it goes against the trend of what I was saying in terms of rising unemployment, but the ABS did tell us that in January there are a lot more people than usual who were considered unemployed, but they actually had a job to start in February. So if that turns out to be the case, we should see a tick back down in the unemployment rate. And I'd suggest to anyone who's trying to work out what's going on in the labour market to actually look at the trend data as opposed to these monthly seasonally adjusted numbers, which have been really choppy over the last 6 months. And if we look at it on a trend basis, what we can see is that the unemployment rate is rising. It hit a cyclical low of 3.5%. It's now up to about 4% on a trend basis. That's exactly what you'd expect to see given the economic growth is below trend. And even if we get a little tick down this month in the unemployment rate, we've still got pretty high conviction at the economics team at the bank that unemployment is going to continue to rise through this year.
Gareth, thank you for talking to Fear and Greed.
It's nice to chat.
That was Gareth Aird, Commonwealth Bank's Head of Australian Economics. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.